Brad Williams, Frugal Finance. More on mortgage. This again is information from, in this case, the Federal Trade Commission. As I've stated repeatedly, I used to own a mortgage company for many years. I have a lot of experience here, so this might be a lengthy recording because I'm going to interject. I'm going to give you my 2 cents worth. Here's my first 2 cents worth. In this training, it's all about shopping for a mortgage. And believe it or not, I'd have to dig up the resource. It was probably from Consumer Finance Protection Board that says only 13% of people shop for a mortgage. 13%. All right, there's my 2 cents. Shop till you drop. There are endless number of lenders. And you can go online and start early. In other words, if you're going to buy a house, start a couple months early and start shopping. In other words, if you find a lender that repeatedly has lower rates than everyone else, and I'll get into why they may have lower rates, just keep track of that. In other words, here's a mortgage shopping worksheet that you can use in order to track this. But again, it's all about the details. It's all about understanding the mortgage. It's understanding the terminology. It is stepping back and decide whether you want to work with a direct lender, a mortgage banker, or a mortgage broker. And you're going, Williams, what are you talking about? A direct lender would be a Wells Fargo, a Bank of America. A mortgage banker could be, I guess there's a United Mortgage Group or somebody like that online. They're the largest lender right now. They're going to be a mortgage banker. What do? They work with mortgage brokers. And what they do is they ask mortgage brokers to resource or bring the loan to that particular group. They're going to pay the mortgage broker a commission. They will package the deal. In other words, they'll process the loan, and then you're going to sign all the loan documents. Then they're going to sell the loan to Wall Street. It's called securitization. And what they do is they'll just package up 100 different loans, and then they'll sell it off to Wall Street. Then the mortgage broker, what they're going to do is they're going to look at, well, what's Wells Fargo charging? What's Bank of America charging? What are the other mortgage bankers and direct lenders charging? In other words, what can I make in terms of a mortgage broker who underwrites the deals cleanly, who makes the job a little easier for our folks and for me? That's what a mortgage broker will do. Will they offer the lowest rates? Not necessarily. It doesn't take long for a mortgage broker to understand that most people shopping for a mortgage just want to get a competitive rate. It's up to you to do your research as to the reputation of all of the players that you're dealing with. With a mortgage broker, you're just going to focus on that particular group. A mortgage banker, on the other hand, is going to be limited. They're not in the industry of shopping deals. They're just going to give you, in most cases, they're not going to underwrite the deal directly. They're going to probably push you out to a mortgage broker. And then a Wells Fargo, a Bank of America, Citibank, they're not friends. They're offering as a service, and they're generally not competitive. I can't tell you, in the zillion years that I was doing this, I never sent anything to Citi. I never sent anything to Wells Fargo. I never sent anything to B of A. And mostly because I despise B of A. They may have the lowest loans in the United States. I despise B of A. So folks that work at B of A, don't take it directly, but this goes back 45 years ago, maybe 50 years ago, when something occurred with B of A and me, and I hold a grudge. So I will never do business with B of A. You know, that's like if you're an Apple fan, if you own Apple computers, you will never look at anything related to a normal PC and a Microsoft-driven platform. And I don't blame you for so many reasons. I, unfortunately, am married to the Microsoft platform. I've tried Linux, but I'm not that keen on programming side. But there are loyalties. And one is, if you're working with a mortgage broker that's been doing it a long time, then stick with that person. Now, there are mortgage bankers out there that have a good buddy of mine. He owned a very, very, very successful mortgage company. And he had retail offices throughout the area. And he had a number of staff that were doing loans. If they're doing loans as a mortgage banker, they have to sign up and they have to register with the National Multi-State Licensing System, the NMLS. I gave up my license 2 years ago, maybe 3 years ago. I held on to it forever and ever. And the thing is, the reporting is it just goes on and on and on and on. It's just really dependent on, very heavily driven off of reporting, which is good because of the 2007, 2008 crisis. But back to the mortgage banker, they could have a staff of people putting together loans. They are quasi-direct lenders and they're selling off the loans. So I may have misdirected you there in what I said in terms of mortgage bankers. They are multifaceted. There's some mortgage bankers that work only with mortgage brokers, and then there's mortgage bankers that have people that are MLS registered that are putting retail loans and then selling them off. In other words, they have a huge line of credit that they package these loans up. I'm going off on a little tangent here. But there are some benefits to working with a mortgage banker, and that is they might be able to do things at a lower cost, and they share that with you in terms of lower overall cost. I never found that sensible because their retail staff are charging considerably more in terms of overall costs. So I always found working with a mortgage broker, you have a little more negotiating room because I have to compete. I have to have a competitive advantage. And my competitive advantage was I was a small operation. So I didn't have a lot of overhead costs. I could share that with you, the borrower. So keep that in mind. Look, ask a mortgage broker, are you a one or two man shop? And if they are, most likely their costs are significantly lower. Maybe you're a great negotiator and they'll pass on some of the savings. That's rule number one. So now let's see what the FTC says. And all this information will be linked below. Know the mortgage basics. That's critical. If you're a first-time home buyer, I know you're nervous. I would work with first-time home buyers. I'd always calm them down. 1, the down payment. 2, the different loan programs out there. 3, the confusion. 4, the costs. 5, can they do it? 6, the credit. That's your starting point. This should say, what's a mortgage? No, it's what is your FICO score? Then it should say, what's a mortgage? Because if you don't have a strong FICO score, then it's going to cost you a lot of money. So I've worked with clients. It took 18 months to do what? For them, pay down their loans, to clean up their credit. They were late. If you have derogatories, those go against you. In other words, you have late payments here or there. You have some 60 days, you have some 90 days. Well, Fannie Mae and Freddie Mac will take a lot of that into consideration. If you have a history, in other words, you had a history, and it shows on a credit report, you may not be aware of this. But from a lender standpoint, we can see your history, your credit history. And if you had a situation 18 months ago or a year ago that impacted your short-term credit. In other words, it could be medically related, or it could be a divorce, or it could be any number of situations. And you can justify that to me as the lender. You can take that into consideration with Fannie Mae and Freddie Mac. They're the underwriters of this deal. They buy the loans. They buy the loans that I package up. Then you can work through some of this stuff. But a FICO score below 620, don't even think about it. So I had a lot of clients with questionable FICO scores. We worked at it. We worked hard. Bottom line is, these people all got into houses, but it took them a while. And I just said, look, this may take a while. You may not use me in the end, but here's the path that I'm going to recommend, and just work through it. Pay off the debt. If you have an explanation as to a default, you walked away from your house, you foreclosed. There's a bottom line rule. It says it's going to take 5 years or 2 years or 7 years. All right, it's on your credit report for 5 years, it's for 7 years. But don't let that shy you away. If you recovered, in other words, you had a default, and it could be for any number of reasons. It was 2 years ago, but your credit has been excellent ever since. the lender will take that into consideration. So don't be afraid. Don't shy away from the gossip. There's a lot of ways to get a loan. The key thing here is your FICO score. Keep that in mind. So now in terms of a mortgage is a loan that helps you buy a home. It's actually a contract between you and a lender. They'll lend you money to buy a home. It's just that simple. It's a loan. You promise you're going to pay that loan back. Hence, it's called a promissory note. You repay the money based on the agreement you signed. But if you default, you don't pay the lender back, you're going to lose your property. Let's not mince meat here. It's that simple. You make a promise, you are responsible for that promise, you satisfy that promise, and in 15, 20, 30 years, that obligation is gone and you own your house free and clear. And there's nothing better than being mortgage free. Not all mortgage loans are the same. This article from this Consumer Finance Protection Board explains the pros and cons of different types of mortgage loans. I'll have a video on this if I haven't already produced it. What should I do to get a mortgage? Figure out the down payment you can afford. Get your free annual credit reports. Get quotes from several lenders. Now, if you're a first-time home buyer, every major city, county will have a housing board, or they'll have some type of housing agency. Sacramento has the Sacramento Housing Agency. They have a lot of programs for first-time home buyers that you won't know about until you open up that door. But I always suggest you check out the housing agencies. Within that umbrella, you're going to have the low housing and a lot of other subsidized programs, but also ask them about first-time homebuyer programs. They have a lot of unique stuff. They have a lot of self-sponsored. In other words, there could be city funding, there could be county funding, there could be match funding from the federal government, not publicized. So you just have to check that out. In addition, it's a revolving door. The lenders out there have to be competitive. So you need to shop around. In other words, you need to find the different programs. And there's a lot of, I can't cover all in this particular video. It would take a lot of work. But there's just some common, here's some keywords you need to know. You have a conforming loan, and then you have non-conforming loans. Stay away from non-conforming loans. What are non-conforming loans? Long ago, there used to be savings and loans. Savings and loans would put together their own loan, and they would hold those in their portfolio forever. Well, they're not the best. At one point in time, I worked for the largest savings and loan in the nation. Subsequently, they went bankrupt. I worked in the very first, it's called real estate owned. It was the very first real estate owned department in the United States. Why? Because this savings and loan had so many bad loans, they needed a group to try to package up those deals and save them from, they were all in default. This particular group had, at the time, they had over 400,000 residential homes across the nation in foreclosure. So our job was to try to figure out what to do with these things because they were money losing. They were just costing the company millions and millions of dollars. Now, hindsight said, Williams, you should have tried to buy those. Well, I did. At some point in time, along my long journey of finance, 40 years ago, 35 years ago, I actually had the documentation to put together, we were going to buy 100 homes, and it was new. It was a new deal. The biggest problem was funding, like it always is. I needed the equity to do it. The demand was there, but the people were reluctant. They're not as open, they're not as keen today as they were 35 years ago, only 35 years ago. Today, corporate America owns, I don't know what the number is, it's huge, residential homes. All right. So I lost that opportunity. Hindsight, it would have been a great deal. But the key thing here is figure out your figure out your FICO. Then down payments. I know I went off on a bit of a tangent. I do that. Figure out your down payment you can afford. Okay, FHA. FHA, Federal Housing Authority, is a resource for first-time home buyers where you can come in and sometimes they have 103% financing. In other words, they'll allow you to cover your closing costs and buy a house. Now, with FHA, there's some problems, and that is they have limitations. One, income. If you're a high earner, FHA won't provide the great programs. And I say they're great programs because they can get you into a house. All right. Two, they're expensive. The loans are going to be priced a little bit higher. And what I mean priced a little bit higher, that is, you're going to have to pay the mortgage insurance premium, or they may have a different, it could be MIP, which is mortgage insurance premium, or premium mortgage insurance, depending on what group you're working with. With FHA, it's MIP. With Fannie Mae, it's PMI. All right, it's just semantics. You're going to have to pay that up, and it's expensive for FHA on that much leverage. In other words, it's risk return. It works for both parties. One, you're getting into a house, and you're doing it without any risk. Well, the lender, the government, is assuming that, and this is all FICO driven, you're going to have a 720 FICO score to take advantage of these. But don't be afraid. FHA will lend at 97%, at 90%, 80%, so on and so forth. What does that mean? That means your loan to value. If it's a 100% loan, you're stepping in without putting any down payment. So that's where you go. If you're going to use a conforming loan, it's typically 80%. Then you get into some other technicalities. That would be, well, you could get a second for an additional 10%. So now you have a first at 80% and a second for 10% more. So the total loan to value would be loan 90 to the total purchase price of 100. Let's use 100 grand, for example. All right, a lot of ways to skin a cat here. Get your free annual credit report. You're going to need to get all three because the lending industry will look at all three, and then they take the average. Get quotes from several lenders or brokers and compare their rates and fees. Period. That's it. You're going to shop, and you're going to get confused, and that's why people go, everyone says something different. Here's my recommendation. Go online. Start there. The costs are going to be much lower if you go online because you're not dealing with an individual. The reason being, if you're dealing with an individual, in other words, if I'm a mortgage broker, you're going to have the principal broker, then you're going to have the agent broker. The mortgage broker is going to have to be paid along with the principal broker. So everyone's going to take a slice of the pie. If you can remove one person or two people or what have you, well, the rates are going to get a little bit lower. Working with a Wells Fargo, Bank of America, Citibank, for example, shop around. Shop till you drop. How do mortgage brokers work? The mortgage broker has to be licensed. And you can go to NMLS. I had a 10-digit number, and it was typically on all of my publications. You have to post it. Whoever you're working with, check in. All right, just think of it this way. You have a contractor working on your house. Hopefully, you check to see that they're licensed. If you have somebody working on your house, make sure you're licensed. 2, go in and see if there are any complaints. See if there are restrictions. If there are any restrictions, check their history. The same here with the National Multi-State Licensing System. They're going to check to see the integrity of not only the broker you're working with, but the parent company and the broker of that company. So just be careful. Be careful, due diligence. Can I negotiate some of the terms of the mortgage? Well, here's the deal. If you're doing this all online, you may get one of these, what you see is what you get kind of deal. Again, if you're trying to negotiate, you may want to work one-on-one where the mortgage broker has literally what I would do. And this was before all of the online stuff. We were in that phase where the online mortgage lending was at its infancy. I worked with probably, and this is where it would get really, really challenging, is there were endless number of people soliciting me to buy my loans or for me to ship my loans to them to underwrite. So I would get a rate sheet, literally faxed to me. If you get 15 fax sheets on a daily basis and you're trying to do business and you're trying to get the best rate, it was just overwhelming. So then a buddy of mine and his buddy, they compiled all of it. They go, well, wait a minute. We know how this works. Why don't we do it for you? And they started a service and they were selling this information. They compiled all of the mortgage information under one umbrella and they'd send it to you. And they'd send it to you a couple times a day because rates were changing. If interest rates are highly volatile, when you're shopping for a loan, they could be repriced a couple times a day. So if interest rates drop significantly on any particular day, don't be afraid to ask for updates, right, before you lock in a loan. And then if you do lock in a loan, and I'll get to that, I'm probably speaking a little early here, but if you see a big change in rates moving lower, you may have an option within your lock term where you can relock once without penalty. So again, it's just a matter of understanding how this thing works and all the moving parts. There's a lot of things in motion when you do a mortgage. There's a lot of behind the scenes activity. At one point in time, I counted how many people are involved in a loan. And I think from the start to the end, and this includes the escrow, there's probably up to 12 people that that are involved in a loan, and the mortgage broker is responsible for that entire transaction. It's a lot of work. So just think, if you're buying a home, they have to deal with the real estate agents. That alone can be a challenge. Then they have to work with the buyers and the sellers. Then they have their in-house processors, the underwriters, the funding people, the escrow people, and collectively, you could see that there are a lot of players involved. So take that in consideration when a loan is being underwritten. Just keep asking you for more information and more information and more information. So how to recognize deceptive mortgage loan ads and offers? If it seems too good to be true, it probably is. In a 6% market, and you see an ads for 5% for apples to apples comparison, you got to ask yourself, that doesn't make sense. So you may see a scenario where you have a low or fixed rate. A loan's interest rate might be fixed or low only for a short introductory period. This is scary. All right. I've never been a fan of adjustable rate mortgages. And when I put together an adjustable rate mortgage, it took a lot of explaining, and people don't want to hear the details. Again, I was a white glove kind of mortgage broker to my customers. If I didn't think they were qualified at the time, I'd work with them, provided that they work with me. On the other hand, if somebody was doing something shady, I fired. I had no problem firing customers because they were trying to scam me, and there's no way I'm going to put my reputation on the line for somebody that was looking for something too good to be true. Well, lenders are not the most scrupulous people. Here we are, 2025. The hot topic is private lending. Well, it sort of goes back to, 15, 20 years ago, where we're running into loans that want to be underwritten without the lender assigning pricing for the risk. In other words, they want to provide these attractive loans. They're going to be private. They're not Fannie or Freddie Mac forming loans. So they don't have to follow any rules. They don't have government oversight. They don't have federal guidelines that must be underwritten by. They're not following standards. They're making this stuff as they go. Now, this is relatively young. This is 6 years in the working. And it's called Oak something financing. Who started this deal? Now they are at the forefront. They're stating we haven't had any major corporate deals go upside down. Well, again, they're private. They don't have to tell you a thing. Don't be surprised. You, as a borrower, don't be surprised. You're going to start seeing advertisements for deals that may seem too good to be true. These low introductory offers, these deals that seem low interest rates that seem too good to be true. Terms and conditions that just seem really attractive without clarity. It will happen because the big Wall Street players are stepping up to the plate. And in order to be competitive, they're going to start throwing around more garbage that benefits them and not you. So just be extremely careful about who you talk to. Ask them straight up, is this a non-conforming loan? Non-conforming also means a jumbo loan. Don't be swayed because it's a jumbo loan. Jumbo loans have been around forever, and they're clean deals. The deal about jumbo loans is the Fannie Mae and Freddie Mac will have a maximum loan amount that they will allow borrowers to lend to. All right. It could be, I think it's $1.1 million now. Anything above that is a jumbo loan. Well, that's a non-conforming loan. But so are some adjustable rate mortgages. So are some loans by big lenders. They're non-conforming. They don't have to follow the guidelines. The next key question you ask is this a non-conforming loan? And what's the fine print? You might also run into lenders that offer to let you make monthly payments where you pay only a portion of the interest you owe each month. Don't ever, 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 don't ever do this, ever. This is what led up to the 2007-2008 mortgage implosion. They're called negative amortization loans. They are set up so you can, it's like buying a car and you go in, well, I can only pay this amount per month. And the lender goes, all right, well, you can pay $200 a month. Well, in a house, you sign a note and it says, well, you only have to pay $200 a month, but your true monthly payment is $400 a month. You're going, what? They sell you on getting into the house, but they don't tell you the total monthly obligation. They're going, don't worry about it. We'll get you in the house. Oh, this negative amortization, don't worry about it. Well, what it is you're not paying the full interest on a monthly basis. So they're going to add that difference to the principal amount, and it just adds on. It just collectively just keeps going higher. Your principal keeps going up higher and higher and higher and higher and higher. It's sort of like when you make the minimum payment on your credit card and you have a $1,000 balance on your credit card. What do you think is happening every month? You don't buy anything, right? So it's January, you have a $1,000 credit card balance, you make a $100 payment, and the actual interest on that is $180. I'm just using that as an example. Well, you make the minimum payment, $100. Well, where do you think that $80 is going? Well, now if you buy nothing for the entire month of January and you look at your outstanding balance on that credit card, it's $1,080. That's sort of the same thing, negative amortization. It is the crap lenders do. They pull this all the time. Why? Because they can make a fortune off of you in terms of their compensation. How do I decide which offer is the best one? Well, find out your total payment. Well, the interest rate determines how much interest you owe each month. You also want to know what you paid for your total monthly mortgage payment each month. Now, keep in mind, there are a lot of numbers here. You also have to take into consideration your taxes and insurance. And in today's market, oh my God, I didn't like insurance companies 25 years ago. I despise insurance companies today. They have you over a rock and a hard place. I mean, it is extortion to the nth degree. And something else to be done about it. I think I may have shared this in another video about what I had to do in 2024 to keep my insurance on my house. Technically, I don't need it, but the fact that we're in this litigious environment, that if somebody sneezes while they're on their property, they're going to sue you. Well, you're almost forced to have insurance. So then you have to play by the rules. And that is, if they say jump, you're going to have to say how high. Well, in California, it's even worse. In the foothills of California, I may have mentioned this, insurers are just dropping people left and right. So there's a last resort that the state of California is providing for homeowners insurance, and prices are tripling to the point or even higher. In some cases, I've read that people are paying more for their homeowners insurance than their mortgage. It's crazy. So people are just saying adios. They're selling their property or they're attempting to sell their property. So with that being said, when you're buying a house, we always refer to an acronym, principal, interest, taxes, insurance. Keep in mind, if you're doing this adjustable rate mortgage, you better know what your responsibilities are. Take a look up in the left-hand corner of this particular video, and I'll have a link up there. And I discuss adjustable rate mortgages and how to dissect the terms, the payments, so on and so forth. Taxes and insurance, taxes, property taxes. Now, in California, it's about 1.3%. New York, I guess it's just outrageous. Here's just a rule of thumb. I might not. I might have to brush. I think it's 0.013 for property taxes, and homeowners insurance used to be 0.0065 of your mortgage amount. All right. That's a rule of thumb. And then if you have private mortgage insurance, I think I used a rule of thumb of 0.0035. And don't pin me to that. All right. I'm gonna have to go back and open up some of my ledgers and take a look. But I used to use the industry uses a lot of rules of thumb, and I think those numbers are close. All right. So PITI, you have to package all this information up, and it's staggering. All right. What's the friggin' average home price now is nearly $550,000 in California. So as a general rule of thumb, you're going to have this 30% rule for mortgage. Your mortgage and interest can only be 30%. Then your taxes and insurance we used to use 38%. High FICO scores, I've seen it up to 45%. All right. That is this entire package here. In the conservative days, you used to use 28, 38, but now it used to be 28%, 35%. So principal interest could only be 28%, and taxes and insurance would be 35%. And as we move along and we become a little more sophisticated in terms of credit reports, what have you, the higher, again, as I said, the opening of this, the driver here is your FICO score. If you have a 720 or above, anything above 720 is just bonus. A FICO score of 800 generally is not much more beneficial than a FICO score of 720. It just shows that you are a good credit risk. So today, you want to shop this around too. You might need to find a lender that has a high combined PITI. So again, 3042 would be outrageous. Again, that's part of the shopping deal. FHA loans are a little more lenient, but again, keep in mind, with more risk, you're going to have higher rates. Having problems getting a mortgage, well, those are endless. If you're a first-time home buyer, you're going to find that it's very competitive if you have great credit. But if your credit report is below 580, you're going to have to work to the best loans out there. You can always get a loan. There's always a lender out there. Is it smart if you have a 580 credit and a lender's charging you 40% more than a conforming loan? No, it's not smart. People do it. People do it all the time because they don't know. The driver here is all about a great, and I use FICO, but it could be any number of names. 2, job. If you're self-employed, it is a challenge. It is a challenge. 2-year history. 2-year solid history of self-employment. That means earning money. If you're 2 years in history and you're not earning money, good luck. All right. In the heydays, back in 2007, you could do no income, no credit check kind of deals. And self-employed people were doing these. But today, you're going to need 2 years history. Then expect a lot of paperwork. You're going to have to just provide all of your tax returns. It works both ways in terms of if you're W-2, you're going to have to provide your tax returns. But with self-employed, you're going to have to provide everything. If you're self-employed and you have questionable credit, again, you're going to have to find somebody to work with to walk you through the process and improve your credit score. There's just no way around it. Do not hire a counselor. You don't need it. If you find a good mortgage broker and ask them straight up, have you worked with first-time home buyers? How long have you been in the industry? Because less than 5 years, you need to be a little bit aware or just recognize that they may not have time for you. But if you find somebody, and you want somebody with at least 2 years track record. Why? Because there are shady mortgage lenders out there. They can be fly-by-night. I've seen mortgage lenders have 20 different companies. And this was before NMLS was formed. And they'd open and close, open and close, open and close. They'd have people, literally, they'd have used car salesmen come in and start doing loans. The barrier to entry of the industry is practically zero. All it takes is somebody to be able to fill out a loan application, and then they can get help from the folks internally to say whether it's a doable deal. They're just selling you the deal. They don't know the intricacies. So you want to find somebody, if you're trying to improve your credit score, find someone that will help you for free. I hate to say that, but yeah, that's the part of the business that loyalty works on both ends. There won't be any guarantees here. You're gonna have a little bit of integrity. That mortgage broker is gonna have a little bit of integrity. And you're gonna work through this thing together. And once your credit has improved, you're gonna do the deal with them. What if I think I was discriminated against? That is critical. And that's not a road I really want to go down. The reason being that that's something you're going to report directly to either the housing authorities, CFPB, or the lender directly. Day in and day out, you're going to see, if you go to the Consumer Finance Protection Board, you can see the different penalties of discrimination. Rocket Mortgage was just saddled with, the middle of December of 2024. I think I read they were saddled with $40 million penalty for discrimination. They're an online mortgage agency. I can't imagine how they could actually discriminate online applications, but they found a way. You have a complaint, file it with the proper agency. The reason being, the Fair Credit Reporting Act has been around since the 60s. But lenders, left and right, Bank of America is notorious for this. That's probably one of the reasons I just despise Bank of America. And Wells Fargo is not too far behind. So with that being said, getting pre-screened mortgage offers in the mail? Yeah. Why am I getting emailers? Okay, that's sort of a redundant question in that people want to get your business. So they're going to send you these pre-screened or pre-approved offers. They're crap. Okay, they're crap, period. Why? Because every single day, mortgage rates change. These pre-screened things, just toss them in the mail. Can you trust them? No. I would never, ever, ever trust any of these things. But look, they send them out because people respond. They may send out 1 million of these things. Now they do it through social media. In the past, the lenders would send out 1 million of these things. If they got a 0.005 response rate, it paid for the marketing. What to know after you apply for a mortgage? Patience, okay? There'll be a link to this article listed below. Everything in the light blue are links. I'll have a video on most of the stuff, but you really need to take it slow because you're dealing with foreign territory. You go in for something medically related, all right? What happens? You see a medical professional and they talk in a different language. The lending industry, the finance industry, the banking industry speaks in different terms, and you are going to be lost because the industry is ripe for fraud. And that is my job, to try to teach you. I know this is a lengthy video. And if you're still there, man, thanks for watching. I do this because, one, I love doing it. Two, it really irks me when I read about people taking advantage of. The resources are here. They're from the government. I mean, if there's going to be one source that you hope is a little more trustworthy than the others, let's hope it's the government information. If you have questions, just post them in the comments and I'll try to do my best to address your concerns. The loan estimates, you're going to get a lot of information. It's called the Truth in Lending Statement. It's a requirement. And it is very, 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 very stringent based on the National Mortgage Lending and the CFPB. I know I'm talking a little bit in terms of some acronyms. This group right here, CFPB, is what may be neutered in this new administration. And that could be a shame. The new administration despises the CFPB. They have been very vocal about it. The CFPB is an absolutely fantastic agency. They provide more benefits to the consumer than can be described. Most consumers don't recognize it. But the penalties imposed by banks, the penalties imposed by scammers, the penalties imposed on these payday loan groups. Why are they being penalized? Because they're crooks. Now, this new administration doesn't see it that way. And I will save my opinions, but I think you can probably pick it up. It'll be a true disadvantage. It will really be a shame if we see the CFPB's agency funding chopped in half or even more. Why? Because with the advent of these new private lending sources coming into play, you as a consumer won't have the resources to become somewhat knowledgeable about the new scams and the new terminology and the new schemes or creativity. So you, in addition to understanding your normal loan payments and what have you, the CFPB requires a lot of documentation from mortgage brokers. And it is overkill from some people's point of view. From my point of view, it makes me responsible to my clients. In other words, I have to follow the very, very tight thresholds. For example, if I give you a quote and you lock in a loan and the total fees change by a small percentage, it could be a mistake. One of my processors transposed a number. I have to start over and I have to reissue that information to you. Some individuals who claim to be mortgage brokers but are not, and you didn't check to see if they were registered with an MLS, could provide the same documentation. But when it comes to closing, that information is incorrect. And because you're under a tight bind and you need to be in this new place as soon as possible, you're going to find yourself being overcharged. This is common. Not as common as it used to be. That the reason why the CFPB came into play. Don't be surprised that if these private lenders come into play, disqualify everything the CFPB has mandated, and you find yourself short at the last minute because somebody said one thing and did something else, stop in your tracks, walk away, and start over. Because we're in an environment where you can have a loan rewritten by a different lender in a very short period of time, all you do, I'm going to emphasize this again, make sure you get copies of the credit report from your mortgage lender, and make sure you get a copy as soon as it's done from the appraiser. You pay for those, make sure you get them. If you find a mortgage broker who is a crook, and I personally ran into one of these problems with a loan, I walked away. This guy was supposed to be a friend of mine and just tried to screw me. I couldn't believe it. It's just the practice people play. But cover your rear end, walk away if you have to. Do your due diligence. This is the shopping part. I haven't got into the meats and potatoes. I'll have a heck of a lot more. Share with me, share with the community some of your experiences. Have you had a good experience? Have you had a bad experience? Have you been overcharged? Have you walked away from a deal? If you've walked away, what were the repercussions? Did you lose a lot of money? Did you recoup your money? Did you sue the mortgage lender for fraud or for some contractual breach? Brad Williams, Frugal Finance. Hope that helped. Stay tuned. A lot more to come.